Welcome. My name is Sasha Moore, and it's my pleasure to moderate today's panel session. Following the tremendous engagement from the recent SMSF Deep Dive webinar, we're delighted to hold a follow-up live webinar to answer all your questions about Q&A. And the reason that we're doing this is really to support broker and accountant sector knowledge about this growth area. So this event is solely dedicated to answering the questions you have about the rules and regulations when establishing, investing, borrowing, and or anything to do with SMSFs. And on this panel today, we have two industry legends. First of all, Chris Levy, who is an SMSF specialist and expert from Aquila Super. Welcome, Chris.
Thank you, Sasha. Thank you. Good to be here.
Fantastic. You're in the hot seat today, so buckle up.
Okay.
We also have with us finance specialist Matthew Porch, who is from the leading private lender Aquamore. Welcome, Matt.
Thanks for having me.
Fantastic. So thank you to all of the registrants who have already sent through their questions. We've got a lot to actually get through today. So we'll go through those first, but I will be keeping a very sharp eye on the chat function as well as the Q&A. So as I said, today is really about answering your questions, and we'll really bucket that into two sections. One, if you have questions about any of the technical side of SMSF, I'll direct that to Chris. And if you have more of a lending finance question, I'll direct that through to Matt. We'll also provide the contact details for Matt and Chris after this session. So if you do want to have an additional discussion after today's session, you can follow up with the gents accordingly. So I'm going to start with some of the questions that have come through as part of the registration process. And I'm going to go to Gia's question first, which is, can I contribute from my equity outside of my SMSF to my SMSF purchase?
Yeah, do you want me to take it, Sasha?
Yeah, absolutely. So, and actually that's a good point. So Matt, both Matt and Chris, if you have a dual response to a particular question, by all means, jump in.
Yeah, sure. Okay. Well, look, this is a good question. In fact, it's probably the most common question that we get, apart from all of the sort of technicalities of an LLBA. It's sort of you might be sort of assisting an accountant or their trustee who's thinking about buying a property, and it's all sort of, it simmers along, but then all of a sudden they found a property and they, oh my goodness, we want to buy this property, but we need to get X $100,000 into super in a very short space of time. And as most people are aware, the gate to get money into super, it's been narrow. The governments over the successive years have made it more and more difficult to put money into the superannuation system, but basically through the means of limits on contributions. And look, the basic rule is that in terms of sort of employer type contributions, deductible contributions, it's only 27,500 that you can put in, per person. It's going up to 30,000 at the end of this financial year. And that's what most sort of people are familiar with: salary sacrifice, personal deductible, that sort of thing. But then in addition to that, there's this, you can actually put, well, it's basically sort of tax-free money. The technical term is non-concessional contributions. The current cap on that is 110,000 per person per year. You can do this sort of bring forward thing where you sort of grab the next 2 years and do it in one hit, so you can do 330,000 per person. So between a husband and wife, you can actually get in under that measure 660,000. And again, that one's going up to 120,000 per year. So I guess those are the things. The simple answer is yes, you can inject money, your own equity, into super, but you've just got to be very careful how you do it. Talk to your accountant before you do so. Yeah.
Okay, thanks for that, Chris. We'll move on to a question that's come through from. Oh, sorry, Matt. Did you have something that you wanted to add to that?
No, it's a good point. Once you get the money in, it's almost impossible to get it out. So don't do anything rash when you get excited and find somewhere, or your client's found somewhere. As a broker, don't instruct them to do anything but roll in money into super without making sure it's the 100% the right decision.
Yep.
Yeah, indeed. Okay, so moving on. So we'll probably stay with you. No, actually, we'll flip to you, Matt. So we've had a question come in from Peter. Can you explain how SMSFs qualify for loans, both for people on wages and those in business? So that actually might be a dual question.
Yeah, so it's a good question in respect of the borrowing requirements. It doesn't really change, to be honest. I mean, wages and it being in business, it's just simply generating income to help service the debt proposition. So self-managed super funds qualify for people, both PAYG and those that are self-employed. Chris, you could probably answer more around the contributions that can and cannot be made on both self-employed and PAYG, but from a borrowing perspective, anybody can set up an SMSF, whether they're self-employed or PAYG.
Yeah, look, the limits look at the type of contributions, not the nature of the member. So I mean, in the old days, sort of 10, 15 years ago, yes, there was a difference, but now the two types of limits are the same. So you could have a wage earner putting in, super guarantee contributions, and then they put up it for salary sacrifice contributions. That's subject to the 27,500. But then you've got maybe say a plumber that's self-employed, and they're wanting to put in deductible contributions. They don't have any sort of super guarantee, no employer putting contributions in. The deductible contributions they're putting in are caught by the same 27,500. And we have had situations where wage earners they're receiving sort of super guarantee from their employer, and they do a top up with the member deductible contributions. But again, the combined limit is 27,500 for that type of contribution. So it doesn't really matter.
Yeah.
Okay, great. Thank you. Well, we'll move on to a question that's come through from Kat. And I think I'll throw this to you to start with, Chris, and then Matt, I'll throw to you. So, Chris, what's the number-one misconception about SMSFs? Like that's a pretty big question.
It is. It was a really good. I had to sort of take that away and think about it. Look, I think that the biggest misconception in the minds of most Australians and a lot of professional advisors of different stripes is that superannuation generally is an investment. People will talk about, I invested X thousand dollars in super. That's not what it is. Superannuation, and specifically, especially self-managed super funds, are just a tax vehicle. And I guess for the types of people that tend to have self-managed super funds, and it includes just average mum and dads that want to get into property, it's just another part of their sort of overall portfolio. It's just mum and dads can invest in shares and property and term deposits and all the rest of it, but they can do it in self-managed super funds as well. And the only real difference is, obviously you can't take it out until you basically retire. But on the other side, you've got these tremendous tax concessions. And so when people are looking at this, they need to work out, where's the best place to do it? Do I invest in my own name, or do I invest it in the super? But don't feel like you're investing in this black box and then you don't hear about it until you're 65.
Okay, thank you. And Matt, what about from your perspective?
Yeah, misconception might be that it's an overly difficult process in regards to borrowing. Yes, it's a little bit more complicated than your standard fully drawn advanced product, for example. But I'd say it's a misconception that it's too complicated to get involved in. Obviously, you had that experience, which you spoke about last time, when that was a number of years ago now. I think things have certainly gotten a lot easier, and there's a lot more education and a lot more understanding of SMSFs. And I think that's reflected in the fact that we've seen record numbers of SMSFs set up in the past 6 to 9 months. So, yeah, it's important that we debunk that misconception that SMSFs are too complicated and too hard to understand.
Yeah, and I think just
what Matt said, spot on. It's particularly in initial stages, whether it's the initial stage of setting up a super fund or acquiring a property through a limited recourse borrowing arrangement, and the complexities can be just quite overwhelming to the average mum and dad, and again, even to sort of professionals that don't work in this space. And I guess what I'd say is, look, lean on the professionals, because it's just a process. You just got to grind your way through. But once you get to the end of it, once your fund's set up, once the property's bought and the structure's all set up, it's very, very easy. It just goes on cruise control. It's it's very straightforward.
And I think probably what I'd add, and what Matt was leaning to, for those of you who weren't at the last session or don't remember it innately, I was saying that there is a legacy perception. And again, it's been through my own personal experience. When I invested in an SMSF about 15 years ago, it was near impossible. It was near impossible to find a lender. It was near impossible to set it up. It was very expensive. It was very, very complex. And I think the point, further to what Matt and Chris are saying, is it is far more accessible now, but where it does become complicated is not in its structure, but if you don't follow a very set process. So if you don't go from A to B to C to D, it's going to become complex quickly. So again, it's not, the structure itself is not complex, the lending itself is not complex, but I guess particularly from a broker's perspective, it's understanding what steps are involved to make sure that when a borrower does come to you, that you do know the areas that they should have covered. And what we'll do after this webinar is we've got a really tremendous overview for brokers, and we've also got an overview for trustees that we'll send. So again, just going into, and Chris, I might default to you again. I know I'm going a bit off piste, but anyone who knows me knows I do that all the time. It does remind me, though, I think it is prudent to really talk about the advice piece versus SMSFs being a product. So perhaps if you can just reiterate on that in terms of brokers providing the finance, not providing the advice for SMSFs.
That's right. I mean, SMSFs are a financial product, and ASIC, they want to protect, well, they get quite ferocious about people being very sort of pushing people into self-managed super funds, without the correct statement of advice and whatnot. So I guess in my experience, when people come to me to want to set up a self-managed super fund or invested property, they've already made their mind up. They may have had another advisor involved. They may not. They may have just done their own research. That's fine. We make it very clear that, look, we're not providing any advice on that aspect of it. But because you can get into a lot of trouble if you are seen to be advocating, look, you should do this and you should set this up. If you do have borrowers that come to you and they want to explore their options and say, oh, look, I'm not sure if it's right, what do you think? Look, you need to actually steer them to properly qualified financial advisor to do that big statement of advice and look at all of their affairs. So just be mindful of that.
Okay, thank you. Well, I will get back on track now. And the next questions come through from Sasha, fantastic name, incidentally. And they said, when are valuations required for properties held within SMSFs, and also evaluation versus an agent's appraisal? So Chris, I'll go to you for this to start with.
Okay. Well, I could talk about it from what does the SIS Act say? What does the ATO expect? I don't know whether financial institutions that are lending the money have their own valuation requirements. I guess Matt can talk about that in a minute. But so under the SIS Act, the super laws, every asset in a self-managed super fund needs to be revalued to market every year, and that applies to property. In the old days, we used to get a valuation or an appraisal or something every 3 years, and that was acceptable. The ATO have moved away from that, and now they're sort of saying, look, it needs to be revalued every year. However, they've also said, look, you don't need a proper valuation or agent appraisal every year. I think they lean very strongly into getting one every 3 years, but in the intermediate years, you can use other information for that. Now, the easiest one, the one most common, is residential property, and there's so much information available out there. There's online sort of property databases. There's the more detailed property databases that agents use. So provided the sort of the level of comfort, they have confidence rather, the level of confidence in this research, you basically trustees can use that to say, look, I've done some research, and they've come up with a figure, and that's enough. So you don't actually need an appraisal every single year. What you do need, though, what the ATO very heavily into, is comparable properties, or sales of comparable properties, and so you need to have that information as well. So in my experience, what typically boils down to is a trustee will go get an agent's appraisal every 3 years, and that agent also has to list the comparable properties they've used. But in the intermediate years, they just go and do their own research, and they'll come back and they'll say, look, here's something from realestate.com, and here's some other properties that we know about, and here's this 2-bedroom here, it's slightly better. And so they basically provide an argument, and that's all you need for residential. Commercial's a lot more difficult. Again, valuation every 3 years, but again, in the intermediate years, you do need to reassess it in some way, and that can be done in multiple ways. It can be a real estate agent, it could be market research, but yeah, bottom line is you don't need a valuation every year, every 3 years, but you do need to do stuff in the intermediate years.
Okay, great, thank you. Matt, do you have anything to add from a lending perspective?
Yeah, valuation would be required up front prior to release of initial funds. After that point, using our structure, for example, we have a 3x3x3. When the second, third year comes around, yeah, revaluation will be required at that point. But as Chris said, that probably ties in with the audit that the trustee is required to do anyway. So that valuation is probably dual serving. So you can actually present that to the powers that be and say, we've actually got a proper, for a first mortgage, valuation from an institutional lender. That's more often than not good enough to satisfy their requirements as well. So,
okay, great, thank you. Well, we've had another question come in. So this one's from Dominica, and she's asked buying commercial property in an SMSF and borrowing capacity. So Matt, I'll throw that to you in terms of how that's structured, because, and I guess that perhaps is coming from a legacy perspective where traditionally there was a set amount of minimum borrowing capacity that you required to then have an SMSF. So Matt, can you maybe talk that through? And then Chris, I'll go to you afterwards in terms of if there is any minimum capacity or any minimum investment that's required from an SMSF property purchase.
Yeah, I think actually borrowing against commercial property under an SMSF is actually easier from a lender's perspective, because ordinarily these are commercial properties with strong long-term lease agreements. Otherwise, the yield's not there, and it makes it a strange investment to be looking at for your retirement, so to speak. In terms of borrowing capacity, I'm presuming that's in regards to like minimum liquidity hurdles, for example, or something along that nature. We don't have minimum liquidity hurdles. A lot of lenders do, which gives them comfort that the self-managed super fund is already set up and that there's X amount of contributions already went into the fund, and everybody involved knows exactly what they need to be doing and all that sort of stuff. We don't have a minimum liquidity hurdle. We think that every deal is based on its merit. We get a lot of startup super funds, for example, where this is the first time that they've done it and all the rest of it. But all the deals are judged from a borrowing capacity on the basis of their own merit. So if there's a strong lease, and do they have the additional concessional contributions that they can make to service the transaction and things like that, we can tick the boxes in that respect. But yeah, every borrower is different from a capacity perspective. So.
Okay, great, thank you. And Chris, I'll throw to you from that perspective, particularly just staying on commercial property. Are there any restrictions in terms of the SMSF side, not the finance side? Is there any restriction about the amount that a trustee can invest?
No. The SIS Act doesn't have any sort of rules about that type of thing. And I have seen instances where 95% of a super fund was in a property. Now, having said that, I mean, it's not particularly wise to do that, depending on where they are in the SMSF's life, because as you can imagine, once you get to pension stage, there's a requirement to pay out an amount to the member as a pension, and you can end up with liquidity issues. Or if a member, if there's a sort of a member passes away, or there's a family law split or something, all of a sudden you've got this one great big asset in the fund, and you basically have to end up disposing of it in some way. There are multiple ways to do that, so you don't necessarily have to lose the property from the family, but yeah, it does create issues from a liquidity point of view. But provided the trustee has considered those as part of their investment strategy, which they're required to hold, that's fine. That's not an issue.
Okay, great. So we've had a question come in from Don. Who are the top 3 lenders for SMSF? So I'm going to answer that agnostically, well, relatively agnostically. So clearly Aquamore are in the private lending space, but what I would really urge brokers to consider is not who's the best lender, but to look at how you're choosing that lender. So if you've got a lender like Aquamore, who is in the short-term space, that's very different to an SMSF lender, say perhaps in the non-bank space or the longer term space. So the quantifying top bit of who are the top lenders, I would very much look at that holistically. I would look at how the lenders, what their product looks like, the duration of that product, the speed of funding, the solution it is covering, whether there are immediate challenges that the borrower has. And as Matt was saying, just looking at things very, very holistically, and again, looking at solution versus rate. The other thing I would just say from a point of observation is SMSF is a really buoyant sector, and it very much correlates with the traditional lenders tightening their credit criteria, which is really evolving the sector quite substantially. So I think that the great part about that is that you do have multiple avenues to source an SMSF product. But again, whether it's in the non-bank space, but particularly in the private lending space, how that lender is funded, ask the questions of whether that's institutional, what their warehouse looks like, et cetera, because from a due diligence perspective, it's really important to be confident that the product that you're offering or that you're deeming is suitable to your client can actually be fulfilled in the capacity that it's being offered. Matt, did you have anything you wanted to add to that at all?
Yeah, absolutely. We offer a unique solution in respect of certain SMSF transactions where the normal players like your La Trobes and think tanks, they do a fantastic job, and I'm got a lot of admiration for their SMSF products. There are certain circumstances where they will drop the ball, or they don't see the holistic approach to a certain transaction. We get a lot of rural commercial properties, for example. Again, strong yields, strong overall borrower profile. And their transactions that we're willing to take on that the other lenders don't, because they have a postcode restriction, or it falls into a postcode that they don't like for whatever reason. There's not enough population in the town, or little things that we're happy to overlook based on the strength of the borrower themselves. We get a lot of SMSFs come in, they leverage themselves and they pay it off, within 18 months, 2 years. They just need that initial leverage to get themselves into the fund and get it started. So we do see a lot of that. But yeah, to answer the question, we've obviously got ourselves and La Trobe and Think Tank, but they're very much down the middle in respect to what they do.
And you actually raise a really interesting point, which is the sequencing of a loan. So it might be the situation that Matt was just saying, that you might place a loan with Aquamorph for, call it, 3 years, and then they might refinance into a think tank or Latrobe or so on and so forth. So I think the further the industry evolves, it's really important to know which lenders also collaborate with each other and where they support each other. And it's very much moved from this lender does this and it competes with this lender. So yes, there is an element of that, but to me, if I was a broker, I would be more looking like where is your life cycle for this particular customer, and it might be short term to start with, and then it might move to a longer term solution, or so on and so forth, or perhaps it just goes to a longer term. So really looking at the SMSF in its stages of its cycle, opposed to it's just this lender or it's just that lender, because SMSFs are niche and borrowers' use for them and circumstances are specific. So that would be my tips from an outsider's perspective. Just be aware of the space, but also where different lenders fit within that circle.
Yeah, I mean, we've had ones where, you know, the clients leverage themselves to, you know, 65%, for example, LVR, and that's out of policy for some of the major SMSF lenders, but the client has partially amortized that debt over an 18 months to 2 year period. A new valuation's been done and suddenly the LVR has went from 65 to, you know, 45. Then it's eligible for a refinance into a major SMSF lender. And we've been taken out in that respect as well. So it's very much a flexible solutions approach that I can't speak for other lenders, but that's certainly the way that we look at it. So.
Okay, great. Well, let's move on. Okay, so Chris, this is a very specific one for you from Mahesh. He has asked, can borrowers use the SMSF funds to purchase white goods and furniture for their SMSF investment property?
All right. Well, look, I'm going to have to get a little bit in the weeds here, the technical weeds. I'm going to give you an accountant's answer, which is basically, look, yes and no. Within LRBA, the LRBA rules, it's not a typical property borrowing. There are additional things that the ATO requires, and one of the concepts is a thing called a single acquirable asset. You can only have an LRBA over a single asset. So, you know, so a single house, or well, yeah, let's use a house. So anything that's sort of part of that house, well, that's okay. But where you have separate things, and so for example, say furniture wouldn't, in my opinion, probably wouldn't meet that requirement. It's sort of separate to the house, even though it may be used in the house, it is still separate. But what you could do in that instance is just get the fund to buy it, because what you've got to understand is this asset's not sitting in a separate trust. It's not a separate family trust. It's a bare trust, and what that basically means is it's still the super fund's asset. It's just held in this kind of separate little area here. And so the fund is entirely able to go and buy these things and put it into the property. Now, having said that, though, there are some you know, white goods, I guess, that do form part of the property, like, say, putting in a dishwasher, like, or I don't know, some you know, some laundry equipment that actually, you know, really become fitted to the house. Well, that's okay. You can use you can use financing to pay for those types of things. But yeah, otherwise, if it's more loose, like furniture or a fridge, you know, because a fridge can be moved. Look, just get the fund to pay for that directly. Don't use the financing for that.
Okay, great. Thank you. Chris, I'll stay with you. From Christopher, how do you help accountants and trustees to understand the need for Reg 8.02B valuations and Reg 13.14 title searches for ATO QC7 3156? I'm glad you're the one who's being asked that question and not me.
Right. Okay. So the title searches thing. What people need to understand is just how ferocious the ATO have been over the last sort of 5-6 years. They've really, like, when you have self-managed super fund, you need an audit. And that's where we come in. And the ATO's view of that audit process, we've had some experiences with them, and it seems to be more akin to almost a police investigation. They really want the auditors to go above and beyond. And there's been a little bit of angst between the profession and the ATO at times, but look, they're the ones holding the big stick, so we sort of have to do what they tell us to do. And going to the title search thing first, in the old days, we used to get a title search every 2, maybe 3 years, just to sort of check on things. Now the ATO is saying, well, no, well, effectively what they've been saying is, no, we need you to do a title search every year, and that needs to be done after the end of the financial year. So practically, it just means that we auditors go and do a title search every year. It adds, 15 to 30 bucks onto the audit fee every year, per property. So look, that's just it's something that we auditors have to worry about. We do get a bit of pushback from trustees now and then saying, "Oh, why are you doing this?" Like, "Well, sorry, ATO." And I guess if we ever get grief, we just give them the ATO information. Say, "Look, there you go. This is what they're giving us." And that also applies to the valuations. As I said earlier on, the ATO insist on these new valuation rules. They insist on the properties being revalued to market every year, and those revaluations use sort of objective and supporting documentation. You need to have proof. You can't. I mean, in the old days, we used to be able to get a real estate agent and say in writing, "Look, this is what I think it's worth," boom, and that was it. No more. There needs to be evidence there. And so again, getting mums and dads to understand that look, I actually have more problems with accountants than trustees. Accountants go, "Oh, why are we doing this?" And it's just a case of when we link the ATO correspondence, we say, "Look, there you go. If you have any, if you don't like it, this is the source." People still get upset about it, but then they just get upset at the ATO. But look, it is what it is. It's, I guess, the way to sort of understand it is it's a cost of having a property in an SMSF. It just is what it is.
And I guess sort of to that point, again, having an SMSF, it did take me a while to understand that that's just what it looks like. Like it is what it is. And
Exactly.
there are certain processes, there are certain things that sort of seem over the top or other. Absolutely. But it's just how it rolls. And I think that's part of the privilege of also having an SMSF is just, when your accountant says you need to do this, it's like, okay, fine.
That's right. I mean, if you had a leveraged property in your own name, you wouldn't have to worry about all this palaver. But yes, there are additional costs by having an SMSF. But at the same time, you get extra tax concessions. So swings and roundabouts.
Yeah, indeed. So an interesting question has come through about rural property as an SMSF investment. So Chris, what have been your experiences with that? And then Matt, I'll throw to you.
Look, I mean, they're very common. It's very common. We do the audit for a lot of firms in regional areas, and a lot of farmers put primarily farmland in their SMSFs. There's a special clause that there's things called the in-house asset rules, and normally you wouldn't be able to have a residential property where people live in it, like the members live in a property that's owned by the fund. But there's a special carve out for rural properties where the residential bit's less than 2 hectares. So, you have a farm and there's a house in the middle. Look, you can actually have that in self-managed super funds. But in my experience, it's mainly just been pure farmland. And they're subject to the same rules as everything else. That has to be revalued every year, which can be difficult, I have to say, although these land agents are getting better at it. When the land is typically used by the member as a farmer, he either usually for agistment purposes, and I have to say the returns can be quite low, but the leasing arrangements, the leasing rates, they're typically supported by a real estate agent saying, "Look, this is what the market adjustment rate is," and we have that on file. What I have found though is that they tend to get very strong capital growth. So from an investment point of view, look, it seems to stack up. It's not just using the fund to help out the farmer, because that's bad. There are rules against that. But as I said, it seems that in most instances, there is legitimate basis for it. So yes, you can have farms and rural property in an SMSF.
Okay, thank you. I know from a lending perspective, Matt, rural can be tricky sometimes. Can you provide some context in that?
Yeah, from a lending perspective, we don't like the agricultural piece. That makes things a little bit too difficult, especially when it's, you're talking about an SMSF, but we do get a lot of like lifestyle properties, for example. Again, if all the other regulations are met, then we don't really have an issue with a lifestyle property. There's a lot of nice houses on big bits of land out there, which are perfect for SMSF. As I said earlier, a lot of regional commercial properties, a lot of like pubs or small offices in little towns. We don't really have an issue with them. So.
And I think that you actually raise a really interesting point of what's actually categorized as rural. So whether it, as Matt is saying, is lifestyle or whether it is actually agricultural. So I think that would be an important one to determine with your borrowers as well. We've had another question come in, and I'll direct this to you, Chris. If the SMSF is in the process of being set up and the client finds the right property, can the client pay the deposit from their own savings and then get reimbursed after?
So this is to acquire property using borrowings or not? Or
yes. So if the SMSF is in the process of being set up, so it's not yet set up,
yeah.
and the client finds the right property, can the client pay the deposit from their own savings and then get reimbursed after? And I think this is actually a fantastic question because it very much speaks to that chicken and egg scenario of doing things in the right order. So Chris, I'll throw to you.
Yeah. Look, it typically no, it's not a good idea. There's a couple of reasons for that. The first one is that if you're doing it before the self-managed super fund's been set up, not the limited recourse borrowing structure or bare trust stuff, but just the fund itself, there's an issue there because you put a deposit down on the property, you sort of enter this contract, and then you create the fund, and then the fund is sort of taking over that deposit. There's an argument, there's a legal argument that the fund is essentially kind of almost acquiring that property from the member. And which isn't allowed. Super funds aren't allowed to buy property from or residential property from themselves. Commercial property is a bit different, but so there's an issue with that. There's arguments. Well, it's an option on a property, but again, there's problems with that. So look, the basic rule is you should set up the self-managed super fund before. Before you actually put the deposit on. As to whether you should put do that if say the fund's been set up, but you've got the money yourself and you want to put the money on a deposit. Well, that's a bit better, but then there's a separate level of risk, and it relates to stamp duty. Essentially, there's sort of two dutiable events that happen when you have one of these properties in a self-managed super fund with borrowings. The first one is when the property is first acquired, and then the second one is when second event is where you've paid off the borrowing and you want to just dissolve the whole bare trust structure and put the property up in the fund. I think it's Victoria, and I think maybe one or two other jurisdictions. They look at where did the initial money come from, and if you've put the money in yourself and it hasn't come from the fund bank account, they will hit you up with stamp duty again. So you get whacked twice. I heard of one instance it got whacked 3 times, just because the lawyers really messed it up. So no, in what you should be doing is ideally having the fund set up, just have a bank account, and then if something comes up, you quickly transfer the money from yourself into the fund bank account, and then from the fund bank account as a deposit.
Okay, great, thank you. So I think the long and the short of that is no.
Yeah. No, it's not impossible.
It's not ideal. Yeah. It's not ideal.
It's not ideal.
And I guess from a broker's perspective, if I was a broker, I would not want to find myself in the middle of that mess.
Yes. So, and just on that point, if you're a broker and you have a client that's indicated they want to get into purchasing a property with a self-managed super fund, look, tell them to go and talk to an accountant or advisor about setting it up first. But then most importantly, get a good conveyancing lawyer lined up, because one of the other mines that can be stepped on is the correct order of entering the signing a contract and then setting up the bare trust. In some jurisdictions, it's got to be A then B. In others, it's B then A. And if you muck it up, you end up with these stamp duty things. So get the lawyer on board just to make sure that it's all done in the correct order.
And I guess to that point, again, ducks in a row before any action occurs.
Right.
They cannot be happening concurrently.
Yes.
Okay, so let's move forward. So Matt, I'm going to direct this to you. So Fazal has asked a question: is lending through SMSF regulated by NCCP?
Really good question, actually. Well, I mean, if the property, I mean, the standard sort of NCCP guideline would be if the property is commercial in nature or it's a commercial property, then the NCCP Act automatically doesn't apply. That obviously changes if there's a residential property involved or if the borrowing is under personal names, but the borrowing is actually under, the trust and SMSF structure. So without, I'd probably need to look a bit more into that one, but I would say that NCCP Act does not apply, in my opinion. Chris, I don't know if you got anything to add about that?
Sorry, Sasha, is that?
Have you come? So you'd probably be less familiar with NCCP in your side of the fence. No, it's more of a financial service. No, that's okay. I think it's actually a really, really interesting question, and I think it would definitely be prudent to investigate that, but that's probably beyond the scope of this webinar. So moving forward, we've got a question from Stephen as to whether you can inherit the property in an SMSF, and if so, how?
Okay, so sorry, to clarify, so you've got a property in a fund.
So what I take that to be is if I have a property in an SMSF, how do I then allocate in my will who the beneficiary of that SMSF will be?
Yeah, okay. So well, I guess just taking the question back one step, I guess variation of questions, can the fund sell or transfer that property back to the member or back to the member's estate or back to the member's kids or something? And the simple answer is yes, you can do that. There's rules about it. It has to be done at market value, not just to comply with the SIS rules, but also the capital gains tax rules, and stamp duty as well. So inevitably there'd be a valuation done at that point. But no, you absolutely can do that, which conflicts with the other way where self-managed super funds can't buy that sort of same property off of a member. But no, so yes, it's very straightforward. Again, if it's done at market value, most lawyers would be able to handle it. It'd be very straightforward. So yes, it'd be very, very easy to if members passed away, to have that property transferred to their kids.
Okay, great, thank you, Matt. I'll steer this to you for this one. There's been a comment saying with offset accounts, some lenders steer away as it may risk placing SMSF assets under charge. What's the general practice? Or perhaps that's you, Chris, I'm not sure.
Wait, is that you or me?
So with offset accounts, some lenders steer away from offset accounts as it may risk placing SMSF assets under charge.
Yeah, I think that's probably sound. I haven't seen it before. I must admit, I haven't encountered that at all. And I think there's some validity to the whole because you're essentially putting the cash account under charge. You're not putting a limited recourse borrowing structure on the cash account itself. So yeah, look, I think there's some validity to that. I'd have to, I think that's right. I don't think that would work in the SIS Act.
No, yeah, it's not something we look at. I don't actually think there's a lot of lenders that have an SMSF offset borrowing account structure for that very reason. So yeah, I think it's something that lenders wouldn't be too keen on.
Yeah, no, fair enough. So I've actually, thank you to the people who are listening who have also chimed in about the NCCP. So we've had a few brokers say that an SMSF is not under NCCP as it's all unregulated lending. So it's definitely an interesting one to explore. I've also had queries to whether or not a link to this webinar will be provided after the fact, and the answer to that is yes. So following today, we will send you a recording of this video, as well as the various assets that you can then use from a broker's perspective, but also from a trustee's perspective. And those who have tuned in who aren't brokers, you're still welcome to obviously use the assets as it's applicable. Chris, we've had a question come in from Damien, and it's quite specific and may not be something that you're across offhand. How much is Land Victoria raising out of all of these annual title searches? So,
look, I reckon well, it's not just Victoria; it's all. I actually reckon New South Wales and Queensland would have the majority, and oh, look, truckloads. And it's not just them; it's also ASIC. We have to do company searches every year. Look, I mean, you know, the amount of additional costs to having a self-managed super funds compared to say 10, 15 years ago. Yeah, sure. There's always, it's not enormous amount. We're not talking sheep stations, but it's just these little amounts. And so, I'm no doubt that these regulatory agencies are reaping in vast extra revenue because of the ATO's position.
Indeed. So we do have back to you, Matt. We do have a technical question just on the financial services side. So what does LRBA mean?
LRBA stands for Limited Recourse Borrowing Agreement, which effectively means that the individuals involved are not providing personal guarantees as such, but the structure of the bear trust and all the rest of it, as a lender, you can actually encapsulate guarantees from the individuals involved.
Okay, great. And another question I'll throw to you that's come through is, can you look at construction finance on SMSF transactions?
No, ordinarily not. It's something that can't be done under SIS regulations or SMSF borrowing rules. Yeah.
And so just look on that, one of those concepts with LRBAs that the SIS Act and the ATO impose is a property that is acquired under an LRBA cannot be improved upon using financing. So a vacant land, well, actually, no, even sort of like a 3-bedroom house, and you want to whack an extra bedroom on, you can't use financing for that. So construction is way off the reservation. And there's another rule, another concept where you cannot drastically change the character of a property, and that's just flat out banned. So whether it's like I said, changing it from a vacant property to putting a house on, or knocking a property down to do a dual occupancy or something, that's simply not allowed.
Okay, well, it seems that the LRBA question has opened a bit of a hornet's nest of questions. So I'll stay with you, Chris. So can a fund purchase several properties within an LRBA structure?
Look, again, yes and no, typical accountant. Yes, an SMSF can acquire multiple properties using LRBA structures. However, going back to that single acquirable asset concept, you need a separate LRBA paperwork for each one and a separate loan for each one, which can be problematic. Just going off on a tangent, 10 years ago there were these stockbrokers trying to do the same thing, but they had to set up separate LRBAs for each different stock. So you had the BHP one and the Westmorland one. So yes, simple answer is yes, you could do it, but be aware you need separate paperwork and costs, unfortunately, for each one. But you can use the same custodian entity for each one.
Okay, thank you. And just staying on the LRBA area, we've had a question come in saying, what happens to the LRBA structure when the loan's fully paid back?
Right. Okay. So, look, we now understand that the ATO don't require you to unravel the bear trust structure. They prefer it if you do, but you don't have to. But typically, most people want to get rid of it. It's just a pain in the neck. And so you can just, if it's been set up correctly, and it goes back to what I said before about, where's the cash come from initially in the deposit and all that stuff. But you essentially, you just fold the bare trust up into the super fund. And that can allow the super fund to do certain things to, for example, going back to what I said before, if it is vacant land or, a residential house, they can actually improve on it. They can make changes to it because you're not subject to all those rules. And so what happens is, the LRBA structure, a bit of legal paperwork, essentially just, dissipates. And instead of the fund kind of owning the property indirectly, it becomes directly owned by the fund.
Okay, thank you. Matt, did you want to add to that?
No, yeah, it's pretty simple in respect to how it all winds up at the end of the day. So.
Okay, great. So Chris, staying with you, I've had a question come in from Yin, who said, I've heard that you can construct brand new properties with SMSFs by appointing another entity to manage the build and purchase the assets after the completion. Is this allowed under SMSF regulations?
Okay, well, look, the basic, just sort of breaking the transaction down. If super funds are allowed, well, they are allowed to buy, a property that's been constructed, or a land and building type arrangement. If the people selling it, the builder, is not related. If they are related, it gets a lot more risky. It's not impossible, but there are some very tough rules. But but again, if the builder's unrelated, look, it's fine. But you can't use borrowing in that instance. Because again, it's an improvement type of thing. Now, look, having said that, there is you've got to be very careful with it, basically. Let me see. You have to look at the circumstances of how it's actually structured. I can see some instances where it might work, but on the whole, generally not. You need to look at what's in the contract, what's the fund actually buying, who's the builder, is there any element of financing involved?
Okay, thank you. Well, Matt, I've had something come in that is probably more in your boat. Can you accept residential property as security on an SMSF loan?
Yeah, 100%. The only thing to keep in mind is that it can't be owner occupied. So you can't live in that property if it's under the SMSF structure. So it has to be an investment.
Okay, thank you. So going back to LRBA, and this is for you, Chris, can property improvements or rebuilds be financed under an LRBA? And what about repairs and maintenance?
Yeah, look, good question. So again, what I said is that under the LRBA rules, the financing can't be used for improvements. So whereas the super fund itself can do that. When it comes to repairs and maintenance, the financing can be used for that. So to give you an example, let's say there's a kitchen redesign, and they want to, so they new paint and all the rest of it, and they put in a dishwasher. Look, that's actually okay. It's a minor improvement. That's fine. But if you want to extend the kitchen out, well, that actually is a significant improvement, and so you can't use financing for that bit, but you are allowed to have the fund, presumably, or hopefully the fund has built up cash through contributions, surplus cash. It can tip that money in to make the improvement. So it doesn't, improving the property doesn't create a breach of the SIS Act, provided it's financed from fund money, not the bank's money.
Okay, and I think we only have time for one more question. So Matt, I'll direct this to you. Some lenders ask for a new bare trust when refinancing the LRBA. Do you think this is more a matter of a lender requirement, as SIS doesn't seem to require that? In theory, they can still keep the existing bare trust when moving to a new lender.
Presuming this is in the instance of a refinance, look, it's my opinion that they can keep the existing structure, but a refinance, obviously there's no cash out component. There has to be a clear benefit for the refinancing itself. You know, if you're bringing in someone from, you know, a long-term product on a good interest rate, and you're bringing them into a shorter-term product with a higher interest rate, it doesn't really seem fit for purpose. So the refinancing part is quite interesting from our perspective anyway. We'll have a lot of longer-term lenders that will refinance Aquamore, for example, maybe after a short amortization period or something like that. But look, from our perspective, you can keep the same structure. There's no issues on our end as a lender, but we don't tend to get a lot of refinances because, as I said, they're not really fit for purpose. What's the point in refinancing your existing SMSF structure to Aquamore unless there's an expiry of term, or if there's arrears on the account or something, which is not something we would look at under an SMSF structure.
Yes, Sasha, I haven't seen that myself, but I have some concerns about that. If they're actually changing the bare trust deed, because it's the legal framework that links the ownership to the fund. You know, you look at the title search, and it's the custodian holding it on behalf of the trustee of the fund. And if you do a new bare trust, there's a danger you're going to trigger something, whether it's maybe a CGT event, but I'm more concerned from a stamp duty point of view. So just be careful of that. Now, if it's a variation to the bare trust deed, that's probably okay. But just be careful.
So I guess again, the insight is it wants something set up to make any fundamental structural change of any description is possibly going to be problematic. So to really understand the implication of that before anything gets into train. I've got a quick question, Chris, that has come through, even though I said that it was the last one, but I think this is going to be a yes or no. So I've had a question come through from Henry saying superannuation is around 11.5% of salary. If a client earns 300K, the 11.5% employer superannuation would exceed 27,500. Does that mean it's capped and the employee only receives 27,500 max?
Yeah. We see this with these surgeons and things all the time. So there's actually a cap. So yes, it's actually 11% at the moment, and there's it's a quarterly cap for some reason. And essentially what it means is that employers can choose to not pay amounts over that cap, such that the poor surgeon's only getting, say, 9%, say. But at the same time, again, going back to the surgeon thing, they might do private practice, but then also work in a hospital, and both entities are paying super, and so combined, they're well over the 27,500. And look, they just get slammed on, on excess contributions tax. There's nothing they can do about it.
Okay, great. Thank you. Well, we've gotten through as many questions as we can. Thank you so much to everyone for tuning in today and for shooting through your questions. But most importantly, thank you so much to Chris Levy, Aquila Super, for again being the all-knowing person of SMSF, and Matthew Porch from Aquamore for giving your insights from a lending perspective. As I said, we will send you through the assets following today's webinar, as well as a copy of the recording, so you can tune into it. And as I said before, we'll also include Matt and Chris's details. Feel free to reach out to Chris if you've got a question about a trustee's circumstance, and obviously feel free to reach out to Matt and his team if you have a SMSF finance query. Thanks again for tuning in. We'll see you next time.
Thanks.
Bye.
Bye.
Thanks.
Bye.